Hello, students. This week we're going to talk about something very cool. You're going to like it a lot, about cryptocurrency investment. Now, by now, we cover the role of finance, money, from where money comes. We talked about the blockchain technology. We have three big lectures and examination there. And now we're going to talk about cryptocurrency investing. But to do this, we're going to have this outline. We're going to look to the crypto asset class feature, what makes crypto different than equity, market status, how to analyze a market status, buy and hold investing, what is that, invest in, buy and hold, difference between investing and trading, crypto 2 betas, investors position, and key technical investment terminology, support, resistance, breakout, candlestick, and moving average. All of those will give you an idea how to invest in a crypto asset class. What is the difference between investing and trading? The difference is the time horizon. The key difference is time horizon. If your time horizon is very long, that we call that investing. Like you buy a crypto and you sleep on it for many years. So whereas trading is a narrow window. There is opportunity with the price is oversold or overbought, and then you make a trade. So the time horizon differentiate between trading and investing. Now, if you buy for 5 years, invest for 5 years and sell it, eventually it has to be a trade. But if you wait it long, that would be investing, then trade. If you wait it short and you sold it, that means you're a trader, not investor. How to be a good investor? Well, you have to follow these steps. First of all, in crypto, to be a good investor in crypto, you have to understand the blockchain. And that's the reason I have 3 classes, which is an 8 weeks course, 3 classes about 50% of the time for the blockchain technologies. The first thing, you have to understand the blockchain technology. Then the second thing is to allocate crypto within a portfolio of equity, not only crypto, because you want to have a diversification and take advantage of this diversification by taking more risk, but will be higher return eventually. And then cut your losses. Crypto, if they have a bad news, usually they go very bad, a lot for a couple of weeks. If you lost, if there's a bad news like FTX, I immediately went out from crypto because I knew this is going to be for a few weeks. Now, after still it's going to be in the news. I'm in December now, December 22, still in the news. It's going to, now pretty much most of the prices are, most of the bad news already priced, maybe another 5 or 10%. But when the bad news come in, cut your losses and leave. What makes the crypto asset class different than equity and other asset classes? First is volatility. Second, it's a speculative asset. The third is the asset holders who own a crypto. As for volatility, crypto is very volatile. They move a lot. So that could be good for trading opportunities. And when we say trading, sometimes the coin is oversold. And then I recommend to go buy it, but you have a window of 20 to an hour to buy it and sell it immediately. Like buy it in the night, go buy it in the night, sell it in the morning. Speculative versus progressive asset. A crypto, it's a speculative asset. Like for example, if you look at the S&P, let's go to Yahoo Finance and show you the S&P. If you go to your S&P, here's S&P. And if you go to maximum, you can see it's a trend here. We call that progressive asset, going up, down, but eventually going up. So there is a trend from here to there where the asset can go. That's, we call it trendy. Now, in a crypto, there is no trend. It's a speculative. It can go up and down. It can be like for a while one regime, a while different regime. So speculative. The third one is who owns crypto. Who owns crypto are the retail investors, not institutional, and that also impact the volatility here, because we don't have a regulation, and we would love to have a regulation for crypto, But as of now, we don't have regulation. So institutional investors cannot invest in a crypto. Therefore, the volume is short, small. And as a result, because only retail investors own it, and they're not big market, that means market size. So the volume will be very volatile, and that causes volatility in the equity market. So what makes a coin market? What makes coins different than equity is the volatility, more volatile. It's a speculative asset, not a progressive. And institutional investors don't invest in this asset class. Here is example. The light blue is the S&P, and you can see it's not moving a lot, but the crypto, it's very moving, and that's speculative, like high, low, high, low. But that's good for trading. The speculation is good for trading because you can sell here, buy here, sell here, buy here. You have always opportunities to buy and sell. So critical stock market timing. Now, I'm talking about, I'm from Denver, Colorado, but most people are in using the Eastern time. The market opened at 9:30, equity market, Eastern AM, which is 7:30 Mountain time. The market closed at 4 o'clock PM at Eastern, which is 2 o'clock Mountain time. The first half of the market prices yesterday and current news. Like, for example, when the market opened, start to see what happened from last yesterday when the market closed till today. What new information, or maybe the old information, start people understanding or process it. In the first half, we're going to analyze the previous information. In the second half, we start pricing the tomorrow information. For example, if tomorrow there is an information about inflation, like suppose we have a good news today, but tomorrow there is an inflation report and people worry it's going to be high inflation, then in the second half of the day, you see the market going down. You see what happened? Nothing happened. There is no news. Well, the market started pricing tomorrow news. That's the reason. So you have to understand why this market swing a lot, because in the morning they price something, in the afternoon pricing something different. Usually in the morning the price is driven by retail investors, but institutional investors come in later in the trading day session, and institution enter the market in the late AM around noon. Don't trade against institutional investors. In the morning, you may be making good trades because you're working with the retail investors. But the movement in the stock market become to be less volatile when the institutional join the market. The volatility become to be less, and you didn't want to trade when against institutional will. Like if the institutional want to go for buy position, and you try to think, oh, it's overbought, it's time to go down. No, they will continue with that. Now we're going to talk about buy and hold strategy. And you hear that a lot in the news. What is that buy and hold strategy? Buy and hold is basically, you like Bitcoin, you like Ethereum, you like Apple if it's equity. And then you make your mind, and then you buy it and you forget about it for 5-6 years. Of course, they're going to go volatile up and down, but eventually it's going to go somewhere. So usually this is a good strategy if you don't have time to every day follow the news. The advantage of buy and holds is great for investors who don't have time. Tax cut, because if you don't trade, there is no taxes. There is no tax in unrealized gain. The only way you can be taxed only if you sell. When you sell, whether you profit or not profit, you will be taxed or credit. The disadvantage is you miss opportunities in the market and risk exposure. Like people who bought and hold in November 2001, now in a bad shape. Why? Because the market went down a lot and they bought it at their peak. So that takes us to the better strategy that I suggest than buy and hold is dollar cost average investing. Dollar cost as average investing, that means you don't put all of your cash in the market. You go and invest in coin. So like now we're in December 22, you should have one pile of investment in February, one in April, one in June, one in August. So you start investing across all the year, and the cost for your assets are averaged across the year. So in every 1-2 months, invest about 50% of your cash, depends how much you want to do. If the market was high and continue to be high, so you put your money and they continue to be high. If the market was high and went low, well, the next time when you invest, you're gonna buy the same company in a discount price. So dollar cost average is very dominant. I recommend that to all my clients, my students, my friends, my family, and I do it by myself. I do dollar cost average. I've never ever all cash or all in. Market status. It's important to understand what the status of the market, because that impact your understanding investment. There are four main status of the market. Correction market. When the market going 10 to 20% from all-time high, suppose the S&P all-time high was $100. The spider was $100 all-time high. If the spider going down to between $90 to $80, that means correction, 10, 20% below all-time high. Bear market, if we go more than 20%, like the S&P was all-time high $100 a share. If we go below $80, that becomes to be a bear market. Bull market, if it's above 10, like if the price of S&P all-time high was 100 and the price is in the 90s or above 100, like 110, 120, so that will be a bull market. Sideways market, as of December 22, we are in a sideways market, which means the market went a lot and then we go like up and down, up and down. There is no direction, not a breakaway up or not a breakaway down. Key financial indexes in the United States, we have the NASDAQ, the Dow, and the S&P. The NASDAQ, it's the more weighted the technology stocks, and we call it the new America. The Dow is the old America, heavily weighted the industrial, oil and gas, and airlines, banks. S&P is all America, which means the tech and everybody, all sectors are equally weighted based on their market cap. Difficulties to implement crypto investment. The problem with crypto investment is we didn't have investment style, value versus the growth. Like, for example, in equity, you can be a value investor. So you buy banks with dividends or oil, gas, and railroads. Or a growth company like PayPal, or companies that growing fast. Like, for example, Amazon is a growth company. Netflix used to be growth. The stock market cap. Type of stock market cap. We cannot invest large cap, small cap. Yeah, Bitcoin is the biggest one, but the rest are small cap. Fundamental versus technical. We didn't have a fundamental analysis. We have only technical indicators. And we didn't have enough sectors. So these are listed difficulties to implement crypto investing. Now we're going to talk about crypto market cap and volume. Crypto market cap is the price of crypto multiplied by the number of coins. P is the price of the coin. Q is the number of outstanding coin. Now, if you go to Yahoo Finance and take, for example, Bitcoin, BTC. So the market cap for Bitcoin is $346 billion, which means 18,000 a coin multiplied by the number of coin. Crypto market volume, which is the number of coin traded multiplied by average price. PA is the average price. So, for example, let's take Solana. See the volume for Bitcoin is $20 billion in the last 24 hours. $19.5 billion. Solana. The volume for Solana is $225 million in average in the last 24 hours. So that's about average volume. This is average. So when I say average, so some people buy it at high price, low price. You look to the average price in the day and then multiply by number of coin. Now support. Now we're going to go talk about technical analysis, how to understand investment. Should I buy a coin, for example? You need to understand the support. Here, for example, in this example, the price of the coin went down, up, went down, up, went down, up, went down, up. It seems like at this price, suppose this price is 200. The price here at 200, the coin does not go below the 200. We call this as a support, that whenever it's going to go to the 200, it's going to go up, bounce up. So whenever, if next time the price of this coin going down to 100, like suppose this is a 100, then I will buy it. No, why? Because I know below 100 it's not going to go. It's going to bounce, and there is a support for 100. The other thing, resistance. Sometimes the price going up and going down, going up again and going down. So we call this resistance. The price cannot go above this level. So therefore, here you should not invest here or here, because there is a resistance. You want to go only to buy when it's here, and when it hit that bar, then you sell it. So investment is good only when you below the resistance line. In this case, 1,202.24. That means when the price going here, it's not a good investment. Trend line, support and resistance. So sometimes you have a resistance, but also a trendy way. So therefore, it's going up, going down, going up, going down, and you can draw a line here, and you can see that it's a trend line support. Sorry, trend line for the price, yes, support, and here a trend line resistance. So summary, here's an example. It could be that the coin can go up, going up, but going up within two upper bound and lower bound, and there's a resistance and support. This is without a trend, and this is with a trend. Can be a support and resistance trendy, and support and resistance could be in no trendy. If the asset is speculative, then this is what's going to be with the asset, crypto asset. So you buy here, you sell here, you buy here, you sell here. If the crypto is trendy, then this is the support and resistance. And then the third, after support and resistance, next will be a breakaway. Here, if the price was bouncing and then become to be higher past the resistance, we call this as a breakaway of the asset. The crypto start breaking away. And I think we can use here example with Solana. Here, it was within ceiling resistance, and then boom, breakaway. Again, become to be ceiling resistance, and boom, breakaway. But sometimes it break. Here we thought we're going to go again, resistance and this. No, breakaway down. Now here again, ceiling and resistance, and then boom, breakaway. So you can see that in Solana that you have a breakaway after a couple resistance in this. Sometimes there's a breakaway, sometimes not, but you can see here resistance and boom, breakaway. That's Solana. So it was a resistance and support, and then boom, breakaway. How to distinguish between a breakaway and support resistance? When we're gonna know like there is a breakaway? The way to do it, here's a secret sauce. Only few people in the world know it, and you will be one of those few. Most professors don't know it. Definitely, they don't know it. The volume. When the volume is up, that means there is a breakaway coming up. You see here, when it was between resistance and support, and I did a lot of research to get this information. The volume was low, but when the breakaway happened, there is a high volume. And it could also, when it break away down, also high volume. And that's secret sauce. So you always have to watch. If you think this is a breakaway, look to the volume. If it was a high volume, then this is a breakaway, and then yes, you're good. If it went up here with a low volume, then it's gonna be going down again. Just some deviation is gonna go down immediately. There's two things left: the candle and moving average. I'm gonna talk about the candle. You have to know, if you're an investor, how to analyze candle. So there are two candles, open of the candles and a closed price. Like if the price of the candle has to do with the time. First of all, you have to say every 5 minutes I'm gonna have a candle, or you can say every 10 minutes. And let me show you example. Here's example, and you can You can do line, and you can ask for candle. These are candle. Now you can say the time interval, 5 minutes, for example. And let me do 1 day. 5 days. Here's a candle. So the candle open and close, open and close. And if you do it more than 5 minutes, let's make it 15 minutes. 4 hours. 1 hour. 1 day. That's another way to do it. You can do 1 minute. All right. And you can do it this way. So you see the candle open and close, open and close. Now, if open at the price was low and close at higher price, then it become to be a green candle. If this interval time, the candle was red, that means that the price open is higher than the price close. If the price close higher than the price open in the interval, that's a green candle. So high and low. So open and close. And if it's green, that means the close price is higher than the blue price, the open price. If it's red, that means the open price is higher than the closing price. That means the price went down. Candle formation. There are a lot of candle formation. You can have your own candle formation. There are 3 main candle formation. They call it hammers, shooting stars, and doji candle. And if the formation happened, that means buy, hammer, and here we explain it, or sell. It's like means you're more bullish. If that happened, that means you're bearish, the shooting star. And here are the explanation: bullish candidate pattern. You can see here, investors hammer. And then bearish candidate patterns, those are bearish. And when continuation, that's a continuation. So there are different patterns, like a green, red, red, and 2 greens, like bullish engulfing. 3 white soldiers, that means red, red, 3 green, 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 green. Most likely it's going to be red after that. After 3 green, mostly it's going to be red. So that means the market, after 3 greens, that means the market is bullish, like it's a good market. So, and here 3 reds, that means the market is bearish. So, and here 3 red. So there are different patterns of candles. For example, when you have a green, green, green here, that means you're a bullish market. The coin is bullish here. And now you have a 2 reds here, and that's the 3rd red, that means in a bearish. And the boom, we're going down. Bearish, like market's losing. Sorry, the coin is losing. So there are a formation. From the formation, you see the formation, say, oh. So for example, you can say we're here now. And let me make that clear. What formation we have now? We have a, let's see if we have a formation to explain it. Yeah, we have this formation, continuation candles. It's just going each other. There is nothing specific. So now I'm going to go to moving average, and we are ready to close this week lecture. Moving average is critical for investment. And I'm gonna teach you next in the other class how to use moving average to make a trading strategy. There is moving average, or simple moving average, which is look to the average of the price in the past 50 days or 200 days or 100 days, up to you. It's an indicator of what's going on now relative what happened in the last 50 days. You cannot make investment for 1 day. Look, you just look what the price today and that's it. You need to look what's going to happen in the past 50 days. So you use a moving average to understand what is the movement in the price. I'm going to go again and make back to line, 3 months, 6 months. And now I'm going to do something indicator called moving average. And then I'm going to use 50 days moving average. And you can see the price of the coin is fluctuating, but the moving average makes the coin smoother, smooth the price. So we can see the price going down, flat, and then going down again. So it's a smoothing all of this noise you have in the price. They clear the noise and make it clearer for you to understand. Here is example. I just show you, and here is example how we calculate moving average. You can see, suppose the price is 10, second day 13, third day was 10. Then the 3 days average will be 10 plus 13 plus 10 divided by 3, which is 33 by 3, it's 11. If the price in the day 4 was 14, then the moving average go to 12.33. You notice that the moving average yesterday was 11, now it's 12.33. But the price was 10, moved to 14. So the price can move faster, but the moving average moves slower than the price. So why we like it? Because it extracts the noise from the price. Okay, so why we need moving average? It's a good indicator, and we explain it extract the noise. It helps you to make a strategy short term, like 50 days moving average versus 200 days moving average can give you some ideas, the trend of the investment, where should go, buy or not to buy. And there are different types of moving average. There's exponential moving average, where you give more weight to the last days. Weighted moving average, you can say, I want to have more weight in the early days, less in the recent days. Volume weighted average, like you give more weight for the days that higher volume. There's a lot of moving average. I use the simple moving average usually. There is a whole moving average, read about it, and you can understand it. And then what is the optimal weight of crypto in a portfolio? And that's the final things, and you're gonna have a homework analyzing that. The optimal weight, now we're gonna talk about investment. We got all of these fundamental ideas for investment. What is that investment? How to invest? What type of market? What status of market? We talk all about that. But now we're gonna say, okay, now I wanna invest. The question is how much to invest. How to do that? First, we're gonna use a Markowitz monopoly price winner model, and he say maximize the return for a given risk. Suppose you have in stocks, equity stocks, and then the question is how much you want to invest in a crypto to add to your equity portfolio. This how much you invest in your portfolio. It's another video, which is, you should have it, and I use Solana as an example, but I'm going to give you a heads up what is the exercise, empirical exercise that you have to replicate using a different coin. Basically, we're going to take a portfolio of equity that maximize the return for a given risk, and then we're going to add the Solana weight, and then you're going to optimize the same portfolio with the adding Solana and see if you improve your portfolio performance. Chapter appendix, here are other bearish pattern, bullish pattern. So there are different patterns. Here's another pattern for bullish, red, 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 and then green. If it's a green, 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 red, that will be bearish. So this is a hammer. So there are different patterns, and you can have your own pattern how to analyze crypto. Here is a list in the appendix also of key indicators. We're gonna go through a lot of them next week. And now here are the questions for this chapter that I want you to answer those. We're done for today lecture. You'll have this video, you'll have the slides, and you should answer this question. Thank you so much, and I hope you enjoy the class and you have a basic idea what is that crypto investing. Thank you.